This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today we continue with our series on growing the value of your business. Today's episode is titled Value and Profitability. They're actually two separate things. Shortly after I earned my CPA or CEPA designation, CEPA is what I'll call it, I had a lifelong friend reach out to me. We're going to call him Jeff, just because I like the name Jeff today. I don't know why. Anyways, Jeff called me and asked me to help him plan his personal finances and position him to sell his business. Now, Jeff is what you would consider a successful entrepreneur. He had new cars, new house, nice house, actually really nice house, fancy cool boat, many employees, and often traveled. Jeff had spent his entire business career focusing on making his company profitable, and he had done a great job at it. He worked tireless hours, seldom took vacations, and he even often joked about with me. He said, Justin, soon I'm going to be on my fancy boat. One day I'll be able to use it. The problem was most of Jeff's net worth was his business. He had reinvested most of his profits from his business back into equipment, back into items that he used to then turn higher profits. It was a vicious cycle. And many times it is, folks. Many times, we make our businesses more than they need to be. Many times he would look at the equipment he had purchased over the years and he could tell me stories. I mean, we would sit on top of the hill and he'd say, Justin, I remember whenever I did this with this piece of equipment and that with that piece. Let me tell you the story when old so-and-so and I did. And he would just tell me stories about each piece of equipment. And there was a unique story surrounding each item. Yeah, Jeff had produced himself a nice income for consumption, but his retirement ticket, as he called it, his business wasn't worth buying. In fact, the only thing worth buying was the equipment. But because of the depreciation he had taken on the equipment, even his equipment, if he sold it after taxes, Jeff would only get pennies on the dollar. He was stuck. He realized that profitability did not equal value. Now look, even though Jeff had a profitable business, the business wasn't an asset of value which someone would pay money for. The 8 core areas of business had been neglected, and profits was king. More importantly, he focused on profits. Jeff found himself tired. He said, Justin, I'm tired. I'm tired of chasing. I'm ready to quit chasing the money. I'm ready to spend time on my boat, man. And yet, if he didn't work daily in his business, his income would fall off. Now, those 8 core principles, we're going to talk about that through this series. But today, there are principles outlined in the series which dramatically change Jeff's future. We've been working for a few years now on rebuilding his business for that potential sale in the future. And now he sees a glimmer of light. Actually, no, he went on his boat, but he had to make some drastic changes. So allow me to set the stage for what I want to discuss today. And I'm going to give you some information from Corporate Value Metrics. Corporate Value Metrics did some research and they pulled some information together, which I just think is fascinating. And there's a chart here. We'll put the actual chart on the blog post and we'll actually put a chart in there and break these out for you. But Corporate Value Metrics did a really good job here and they identified the 3 segments of the market. So let me explain those segments first. First, you have what's called the micro market. And these are where the revenues are traditionally under $5 million in value. So in the micro market, there's currently about 5.6 million businesses in the United States. Roughly 93.9% of the businesses out there fall in the micro market. You may call these small business owners. And this is where I tend to see people start. Obviously, that's where I'll start. But then people want to get to the lower middle market. So the lower middle market are those businesses which have revenues between $5 million to $100 million a year. And currently, there's only about 351,000 businesses in the United States that fall in this lower middle market. So whereas the micro market had almost 94% of the total amount of businesses, the lower middle market only has about 6% of the total businesses. And then you have the big businesses, or the upper market, and those are $100 million plus. And those are typically publicly traded firms, or those firms going publicly traded. But for the majority of folk, the micro market is where it housed. Now, what's interesting to me is the number of employees that are hired by the micro markets. Out of this 5.6 million businesses, they currently hire somewhere in the neighborhood of about 34 million employees, give or take. Now, the lower middle market, this is intriguing to me. Out of the 351,000 businesses out there, those 351,000 businesses actually hire almost 30 million employees. So they actually have 25% of the employee share, whereas that 5.6 million micro market businesses have only about 29% of the employee share. And the reason for that is a micro business could be a handyman. I had somebody fixing something at my house, one of my rental properties that I'm currently selling, and he's just a standalone do-it-yourself guy, just himself, but he's a business, but he has no employees. Whereas when you get into that lower middle market, those businesses with 5 million to 100 million, you begin needing teams in place, employees and managers, etc. So I find it intriguing that the lower middle market only has 351,000 businesses currently represented. Now their sales is $5.8 trillion. I mean, there's a ton of sales there in the lower middle market. The micro markets, which is the 5 million and less, they currently have about $3.5 trillion in sales. So that would tell you that the large, big companies, they consist of about 68% of the total sales with 20 trillion. I mean, they just are crushing it, the amount of sales these big companies make. So I give you that information to now introduce to you the reality of us as business owners. And I'm trying to drive the point home that profitability does not equal value. So I need to use some information here to drive the point home. And so let's take, for example purposes, and let's analyze this lower middle market. Now remember, lower middle market is those with sales range of $5 million to $100 million in sales. And there's currently about 351,000 businesses in the lower middle market. Now, in a private market study done by pepperdine.edu, and I'll put this in the show notes and the blog post, there are currently, like I said, 351,000 middle market businesses. Out of those 351,000, 250,000 of these businesses are expected to try to exit by the year 2030. Yeah, that's like 3/4 of those businesses out there that fall in this 351,000 middle market businesses. About 3/4 of them are expected to try to sell in the next 12 years. Here we are in 2018. We're talking by the year 2030. Man, that's 12 years time. Well, why is that? Well, these are the baby boomers. Majority, I think it's 76% of the business owners here in this area are baby boomers. And the reason why it's all coming up to a compression is because of the recession that we dealt with back in 2007, 8, and 9. And those individuals who thought they would be selling about right now, their businesses suffered and they didn't have assets set outside their business. And so now they're looking at about another 10 years for themselves to exit the company or exit the marketplace. Now, here's where it gets scary, folks. So roughly 250,000 of these companies are going to try to sell in the next 12 years. But out of those 250,000, only roughly 50,000 will be deemed market ready. See, what happens is many times people will say, I'm ready to sell my company. And they go visit with a broker or they visit with a mergers and acquisition or investment banker, whomever they choose as the person to help them through this process. And now the broker looks at the business and says, you got some work to do before we can get this thing ready to sell, because they know what the buyers are looking for at that particular time in the marketplace. So here we are, out of the 351,000 companies in the middle market, 250,000 expect to sell. And only 50,000 of those within the next 12 years will be deemed market ready. Now it gets even scarier. Out of those 50,000 which are deemed market ready, only 30,000 will actually transact. That's a 40% transaction failure rate from that 50,000 who want to sell. So 40% of those who think they're ready to sell, and the brokers believe, or the investment bankers believe they're ready to sell, roughly 40% of those individuals will never sell their business. That's dreams that don't come true. Now, here's where it gets even scarier. So out of those 30,000 that will actually transact, roughly about 16,000 of those will sell with concessions. So that's more than 50% of those will not sell at the value that the individual wants. See, they're going to end up things with like concessions or carve-outs or stock or notes, or they're going to be a price reduction, or you just don't know. So out of those 30,000 that will actually sell, 16,000, more than 50% of those, the buyer or the seller is not going to get what they want. Then that leaves roughly 14,000 will actually sell at the desired value. Now let's put that into perspective. There are currently 351,000 business owners right now in the middle market. And those who want to sell in the next 12 years, so out of the 250,000 who want to sell in the next 12 years, 4% of them will actually sell, and the business owners will be happy with what they get. Now, friends, I don't know about you, but that's depressing. In addition to that, we're only talking about those who sell. 80% of the businesses out there will never sell. Let me say that again. 80% of our businesses will never sell. Friends, that's some pretty amazing statistics. And yes, I know we're only talking about the middle market. And you say, Justin, that's only the big boys. No, the micro market's even worse. Out of those 5.6 million businesses in the micro market, the numbers are even more dismal. Yet when I provide a business owner with these national statistics, I occasionally hear a story about a friend who, well, buddy, Justin, I got a friend who sold their company for 5 times. We may have even heard of that. We may even have stories of ourselves, and we say, one of our business friends, they just sold their company and they didn't have a big issue with that. Well, there's a lot of things that I could get into here. Probably the most popular thing as I hear is that they're going to sell it for 5 times EBITDA. And this sounds good. And I said EBITDA, earnings before interest, taxes, depreciation, and amortization is what that stands for. And it sounds good. It sounds good to say 5 times. But here's the thing. It's a generic formula, and it couldn't be further from the truth of what actually happens. So first of all, we already know that out of those businesses who want to sell, 80% of them will never sell. Roughly 20% will. And out of those 20% which sell, only 4% of the total amount of businesses who want to sell will get what they want. So first, let's deal with this assumption that, hey, we got a buddy who did this. You know, truly, maybe you do have a true friend that you can sit there and look at all the details of the numbers. But the things are not the same. The things are never the same. So let's deal with that so I can explain why profitability and value are not the same. Unless we're intimately involved in the details of a transaction of one of our friends, and I've been in many of them. I've been personally in these, okay? I've already sold 3 businesses to date. We don't know the details of the transaction. For example, was the deal actually based in EBITDA? Was the EBITDA manipulated? Yes, it can be manipulated. In fact, Harvard Business Review wrote an article on the topic about how EBITDA is manipulated, and it just sent waves to the appraisal world. Or maybe was the deal based on EBIT? Or was it based on cash flow or revenue or collections or net revenue? You see, we may hear the factor or the factor that's applied to the revenue source, but we may not know the revenue source. So when I hear 5 times, I want to say, well, 5 times what? Was it EBIT, cash flow, revenue, collections, net revenue? Was it EBITDA? Was it a recasted EBITDA? Was it a normalized EBITDA? So we never know the exact details.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
The second thing that we often never know is the size. And friends, size matters. Size matters in many things, but in businesses especially matters. Let me give you some stats here. Businesses with revenue less than 1 million average 3.69 as a factor of EBITDA. So if your EBITDA was $100,000, then you got 3.69 times $100,000 since 2017. That was the average. While those businesses between 1 million and 5 million transacted at 5.42 times EBITDA. So if we're dealing with EBITDA and we have a $1 million business and maybe it's a $2 million business, we're getting 5 times that. But those businesses with 5 times or 5 plus in revenue average 4.3% of EBITDA. And these are exact numbers, and I'll put their source in here on the trends from 2017. And if you go back in 16, you're going to notice the numbers are different. And 15, the numbers are different. And 14, the numbers are different. And now we're just using EBITDA. But if we used SDE or revenue, the numbers and the factors change and the numbers become even more muddy. So I'm going to put a graph in our blog post that will explain the way that the numbers work. My bottom line is this, is that whenever we hear a buddy or a friend or someone out there say, well, I just sold my business for 5 times. Well, 5 times what? Was it 5 times EBIT? Was it 5 times SDE? Was it 5 times EBITDA? Was it 5 times revenue? We don't know. And then those numbers that we look at within those scenarios, they could be totally different from the way that you're keeping your own books. EBITDA can be manipulated. So we hear these things out there, and my only warning is be careful. See, the multiple, which is applied to the revenue number, works on a bell curve. And we've seen the bell curves, like the bell that you would have like in a church tower, or my kids want to go see the Liberty Bell. We were just talking about the other day, like to take them to Philadelphia and see the Liberty Bell. As you heard in my last podcast, I'm somewhat fascinated with Franklin, and I think it'd be cool to go up there and see some additional things in Pennsylvania where Franklin was a part of. But we were talking about the bell, and we all know the bell and the bell curve, right? We dealt with this in school, in business school, some account, whatever type of school. We've all seen the bell curve. See, but at the top of that bell curve are those average numbers I was just giving you. So, for example, we're dealing with EBITDA on a business between $1 million and $5 million in sales. The average EBITDA was 5.42 for 2017. Now, we know to the right side of that bell curve, the multiple will be higher. And to the left side of the bell curve, the multiple will be lower. And truth be told, some businesses operate in the higher multiple range, and some businesses operate in the lower multiple range. So when we hear 5 times EBITDA or 5 times percentage, we never really know the details of it. So let me see if I can make this make sense in a technical language and something that may be a little bit more financially simple. I want my business to value in the upper echelon. I want it to be a top tier business. So if the average is 5, let's just use it as an average, and that's the top of the bell, why can't my business sell at 6 or 7 times on the right side of that bell curve? It has nothing to do with the revenue. You may say, well, Justin, just go out and make more money. No, that has nothing to do with the way valuation works. Valuation works on the marketability of your company and how the potential buyer, or buyers plural, will look at your company and what they're willing to pay for. So let me give you the tale of 2 companies. Both companies have the exact same key details. So let me lay them out for you. They're both 20 years old, so they've been around a while. They're in the exact same industry. They have the exact same amount of sales. Each of them are producing $5 million in sales right now. Their EBITDA is the exact same. The EBITDA is $500,000. So we have everything's the same. They're both 20 years old. They're in the exact same industry. They have the exact same sales amount. They have the exact same EBITDA. They're experiencing the exact same nominal market growth. So from a simplified business, we should say these companies are valued at the exact same value. Well, that's not true. So let me put company A and company B. So company A has no product development, but company B has a robust product development. Company A has some worn equipment, and company B has pristine equipment. Company A has a weak management team. Some in places it's even non-existent. But company B has a very capable and a very developed bench. They have an outstanding management team. Company A has no strategic planning in place, and they can't quantify where they've come from. Company B has a highly developed strategic plan. Company A doesn't have any CRMs, and they have some old KPIs in place. Company B has state-of-the-art technology, providing them clear, up-to-date information on how they can project their business. Company A, on the other hand, has no financial reporting. Other financial reporting and forecasting is unreliable. Company B is disciplined. They're using modern and most up-to-date financial reporting capabilities. Company A doesn't train their employees often, or if they do, it's very seldom. And Company B has some very robust training capabilities and regimens. So just in those simple scenarios, side by side, which company would you pay for? Would you pay for the one that has no product development, worn out equipment, a very weak management team, no strategic planning, old systems, unreliable finances, or very seldom employee training? Or would you be willing to pay for the one that has robust product development, pristine equipment, very developed and capable management team, a highly developed strategic plan, state-of-the-art CRMs and state-of-the-art KPIs, disciplined financial, and a robust training team? Which one would you pay for? You You said, Justin, that's a no-brainer. If they're both identical, they both are producing $5 million in sales, they both have $500,000 of EBITDA, they both are 20 years old, they both are in the exact same industry, yeah, I'd buy the one that has been investing in the business. Well, of course you would. And that's what most buyers would look at, because why? The sales are all the same, but we're looking at it saying that company B, in this example, they are postured for the future. They have been investing in themselves, and now they have a team in place which could help them reach their long-term goals. Yet often, instead of building companies which are valuable, like Company B, we chase profits. We are trying to drive revenue and drive bottom line profits. Now look, before I get hate mail, please, before I get hate mail on this, I'm not saying to ignore profits. That's not what I'm saying. But what I am saying is chasing quantitative results can negatively impact your organization. Yet, because we need the revenue, we often focus on quantitative. However, just a change of thinking. If we can focus on qualitative, on the qualitative factors of business that drive the quantitative results, if we can look at the things which make our money, we can align the strength of our company, improve profitability, enhance our access to capital, reduce risk, and maximize the value. So yes, value and profitability are two different things. As a business owner, it is so easy to succumb to focusing on profitability, the quantitative results. But if you and I focus on driving the value, the qualitative results, the profitability will follow. And maybe, just maybe, in addition to seeing unbelievable increased profits, we potentially could sell the company for an added bonus in the future. So friends, value and profitability are two different things. Don't be like my friend who spent his whole life trying to drive profits but never had value. And especially don't be like people I see who drive profits and then don't save anything outside their business. You know, it's one thing. You may say, Justin, I don't have a company that I'm ever going to sell. Okay, that's fine. We can deal with that. But you can position your company nonetheless to where whenever the time does arise that you are financially independent outside of your company. And with that, I'd like to thank you for joining me on the Financially Simple podcast. As always, the show notes. And look, today we had a ton of them. We have a bunch of links. They're going to be found at Financially Simple. Go underneath the heading podcast. Hey, and while you're there, on the left-hand side of the screen, click on our weekly newsletter. Just go ahead and sign up. Subscribe to it. Every week I release tax tips, business planning tips, wealth management tips, so much more. If you like the show, please subscribe. Hey, do me a favor. Share the podcast, share the YouTube video with other business owners. Tag me in it. Do me a favor. Tag me in it. Say, hey, Justin here, hammer this thing down on value today. This is really interesting. Well, take a look at this. Tag me in that if you don't mind. And as I say every week, life is hard. Life is good and life can be frustrating. Money doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.